These are just a few notes on the indirect method of drawing up a cash flow statement, and I've added a couple of slides. So we start by pretending that profit is all cash, and then we start adjusting. We add back non-cash expenses and that's depreciation and interest charge, which is not necessarily interest paid. Depreciation expense, you'll appreciate, is not an expense that is paid at all. Then we've got this rather complicated area where we talk about inventories and receivables, where an increase is a use of cash and a decrease is a source of cash. So really what I wanted to do was just to explain that. Just to continue on, we then deduct the interest that is actually paid, and then the tax that is paid and the dividends that is paid, and that gives us our net cash flow from operating activities. Just to whip back to the cash flow statement itself, that's net cash flow from operating activities that we're just talking about, and then we do a similar sort of thing for financing activities, and net cash increase from that and the overall, and that explains the movement. The 907 there is the movement between cash at the start of the year of 2174 and cash at the end of the year 3082. So our indirect method explains the movement in the cash balance from the beginning of the year to the end of the year. Okay, so let's pick it up from there. So to summarize the movement in assets and liabilities, we have first of all, we've got a balance sheet here. I perhaps shouldn't put this up quite so soon. We've got a balance sheet. I've rearranged it. Sources of funds equals use of funds. These are the fixed assets, the current assets, and this is an account of all those who've got a stake in the business. In this case, we've got equity, shareholders, we've got liability, which can be anything from bondholders to creditors. So all these have, in a sense, lent money to the company, and these are the assets that value represents, ranging from land and buildings to straight cash. And remember, if any profits are made, that increases the assets and increases the equity. So there's always a balance between the two. They should always equal each other. Now, when we apply the logic of the cash flow statement, we can see easily enough that an increase in the source of funds is going to be a source of cash. Well, possibly. If it's equity, new shares being issued, then that is going to be directly in the form of cash. If it's an increase in a liability, if it's a bank loan, again, cash. But if it's an increase in creditors, it may be that it's for stock, and that isn't actually, that's an increase in assets more than anything. So, but we can pretend it's like an increase in cash, and with the cash we bought the assets. And in this way, the source of cash is a little bit of an approximation. It sometimes doesn't actually go through cash, though in theory it could. So this is an increase in funds, as it's sometimes called, but we also call it an increase in cash. Then use of funds here, a decrease in this is a source of cash, and that's a little bit difficult to explain why, but we're kind of saying that if debtors decreased, then we would assume those debtors have paid. Now, that isn't always going to be the case. Some of those debtors are going to transfer themselves into expenses, and they're not going to result in cash, but in the main that's going to happen. A decrease in stock we assume is sales transfer to debtors, and debtors into cash. So again, an indirect path, but in the main it's going to lead to cash. And then a decrease is going to be classified through the logic that it's either going to be an increase or decrease in cash. A decrease in the source of funds is a use of cash, and this may be a straight cash payment of a creditor, for example, repayment of a loan. So again, this is going to be largely cash transactions. Then an increase in non-cash assets is again a use of cash. So an increase in stock we can treat as being as if it were purchased with cash. So that's treated as a use of cash. But again, an increase in stock may be due to an increase in creditors, but that's a source of cash. So these are transactions which can go in theory through the cash account. So I think that is reasonably clear. That's reasonably clear. That is reasonably clear. That one is not so clear. So where's the logic for this? Because all this, if we put it all together, magically explains the difference between our opening cash account and our closing cash account, as we saw at the beginning. Well, just to explain that, we've got our accounting equation here. I've extended it a little bit. Fixed assets plus current assets plus cash equals equity plus liabilities. And I've just given them letters just to make it a bit clearer. So nothing special there, but the subscript T0 means at the start of the year, and the subscript 1 means at the end of the year. So we can rewrite this equation to put cash on the left-hand side and everything else on the right-hand side. So it's going to be D0 plus E0, then take these over to the other side, so it's going to be minus A0 minus B0, which is what we've got there. Then, so that's the position at the beginning of the period, and at the end of the period that's the balance. And both beginning and end periods we should have our accounting equation balancing. So effectively what we're doing in our indirect method of the cash flow statement is comparing time 1 with time 0. In other words, we're explaining the cash flow, the movement from C0 to C1. And we're doing it not by looking at it directly here, but looking at the effect of all these elements on our cash balances. So now hopefully it'll be clear simply as a matter of the equation that where D1 and E1, that is equity and liabilities, represent an increase, then that's going to be an increase in C1. And then an increase in A1 and B1 is going to decrease C1. So in that sense we can say an increase in our fixed assets and current assets represents a use of cash, a decrease in the cash balance here. And then an increase in D1 and E1 increases C1, so that we call a source of cash. And then the other side of it, a decrease in D1 and E1 decreases C1, so we treat that as a use of cash, and a decrease in A1 and B1 means less is being deducted, and so C1 is increased. and therefore that is a source of cash. So the double entry logic implies that we should be able to explain by these increases and decreases the movement from C0 to C1. So hopefully it's a little bit less mysterious, though if we go back to the previous slide, normally people satisfied with the logic remember it like this. Okay, so that's my brief look at the indirect method.